You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everybody. Welcome back, Brandon. Earnings season is almost upon us. I think we're
almost.
What is it, next week that we start to see some companies trickle in with their earnings?
Just having a look at the earnings calendar. It seems to all kind of start next week. Chipotle, Coke, Netflix, airlines, Snapchat, Twitter, all kind of happening next week. So yeah, it's that time of the quarter again, I guess. It happens once every 3 months. Is that all the companies that everybody follows reporting their earnings, and we get to make a lot of content about it from our end.
It's a good time of year. It's a good time of year to be doing a podcast and or a YouTube channel because there's so much content you can kind of draw on, and there's always little interesting things that are happening and announcements from companies that people don't expect, and stock prices go up, they go down. So I don't know if you find this with your YouTube analytics, but I seem to be like every 3 months I'll have like a great month, and then the next two will be a little bit less, and then that third month will be good again. I think it's just in line because we've just got so much more to talk about when earnings comes around and the 13Fs are coming out. We get to see what all the big investors are buying and selling and that sort of stuff. It's kind of funny how we're kind of like, we've got all this information at once, we've got to make all this content, and then after that it kind of fades away and we've got to actually make our own original content. It's I don't know, being in the finance space on YouTube is it's very cyclical or seasonal. It's very up and down, very volatile. So we kind of just have to do our best to navigate that. But we've got a few different things to talk about. We've got a story from last week around Trump and his battle with the big social media giants. Bit of news out of Robinhood and their initial public offering. Richard Branson did something fun earlier in the week, and some AMC news and some US government bill spending news, which is always fun. That's the one I'm excited to talk about.
We just sent everybody to sleep just then. Oh, do you want to hear about this new bill that just went through? There's some legislation updates, and we've got some interesting news about bonds today. Switch off.
No, so we'll start off with some exciting stories to get everyone awake in the morning, Saturday morning. Well, I guess it's probably not Saturday morning for everyone listening to this, but anyway, we've got a bunch of stories to get through. And before we get into that, I'll just go through our sponsorship for today. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So basically, you can pull in all of your trades either automatically from your broker, so you don't even have to do anything, or you can do it manually if you want as well. And it will give you an accurate picture of your overall portfolio's performance, including the capital gains, dividends. If you do dividend reinvestment plans for index funds or stocks, it will do all of those calculations for you. Also, currency gains, which most people don't track. So if you're buying shares internationally or you hold foreign currencies, then currency fluctuations can have a dramatic impact on the return of your portfolio. So you want to be tracking that. And then the other thing that you can use it for is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to work out things such as your capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, or you can also use that link to get 4 months off a premium plan if you sign up to a yearly subscription. So particularly if you're in Australia and New Zealand, tax time is upon us. It's not too late to get your portfolio and trades in order, and using something like Sharesight can save you a ton of time and even money. And you can probably you may be able to use it as a tax deduction. So you can talk to your accountant about that as well.
Yeah, cost of managing your tax affairs, of course.
Exactly right.
Yeah. Although I am not a tax accountant, so maybe check with your accountant just to play it safe. But I would imagine so. But anyway, check with your tax accountant. But thank you very much to Sharesight for sponsoring.
Yeah, well, I want you to start with this story. This first story, yes. Richard Branson. What happened?
Did you see this?
I saw a little bit of it. Yeah.
Okay.
I didn't watch the whole thing.
It was awesome. I mean, I love space flight. That's like one of my not hobby interests, I guess. Like I don't know anything about rockets or anything like that, but I just love seeing all these achievements that are being made in the space industry, I guess. And we had another one this week. We were talking about Jeff Bezos, how he plans to go up on the Blue Origin's New Shepard rocket, but Richard Branson beat him to it. First billionaire in space. Haha, sucker.
Was he always planning on going before Bezos, or did he just like sneak that in? Well, Branson has always wanted to go to space. That's been like a long-term dream of his. So he was definitely going. But I'm not sure about whether he, whether he saw Jeff was going up and he went, whoop, I better get in first. But I tell you what, he probably did a smart thing, getting a first mover advantage and actually being the first one, because there's just so much media, at like crazy amount of media. But anyway, we'll get to that. So what did he do? So he is the founder, Richard Branson we're talking about. Sir Richard Branson, actually, is the founder of Virgin Galactic, which is a publicly traded space tourism company, if you're interested in checking it out. And he founded it with the intention of building a rocket system that could take people up to the brink of space. They can experience weightlessness. They can look out the windows and look down at our Earth. And then they can fly back down and have this awesome space tourism experience. So they've been working on this rocket, and the rocket itself is, imagine like a normal plane structure. You got your cabin, your two wings out the side. This plane looks bizarre. It's like 3 planes in one, right? So you've got 2 wings and then you've got 3 cabins, 1, 2, 3. So what happens is the tourists get in the middle cabin, and then the whole thing flies. So it takes off like off of a runway. It flies up. I think it's like a 2-hour flight. They get up really, really high, and then they're in this middle cabin. Then the middle cabin breaks off of the spaceship, and it in itself is its own spaceship. It's got a rocket engine on it. It falls away from the main spacecraft, lights the rocket engine, and then just rockets up to space, like pretty much just a straight line up. They're not trying to get into orbit or anything, so they're not going horizontally. They're just going straight up, weightlessness for a bit, and then straight down. Wow.
So it was awesome. Anyway, so that spaceship is called Unity. So Richard Branson, he launched on the spaceship Unity. He got to the brink of space. It was all live streamed live to YouTube. So if he was going to blow up, we'd see it happen in live in real time. Luckily, Richard Branson did not blow up. It was like a 2-hour live stream, and we just got to see him rocket up, float around in the ship, and then coast back down and land back on Earth, and that was that. He experienced about 3 minutes of weightlessness. He gave a 30-second speech or something about being a dreamer and how he encourages all the kids out there to do whatever. It was all very inspiring, Hamish. Did you see it?
I saw clips of it. I didn't watch the whole thing, and I didn't watch. I didn't watch all that much of it. I'll be honest. I wasn't that too interested in this.
Right. Okay.
I don't know. I just I was kind of the person who was like, oh, that looks kind of cool. Looked at some 3-minute clips, and then that's kind of enough for me. But yeah, really interesting to see it. The space ship looked. Yeah, it's very strange. Looking, you're right. It's I was very confused by it, but very interesting, very good. I'm sure for the marketing for not only Virgin Galactic but just Virgin in general.
Yes, and that's why I wanted to put this in the Young Investors podcast. Uh-huh. And I have actually made a video about this on my channel, but I thought I'd bring it up here as well because I find it very interesting. Beyond, like, Bezos and Branson both have these dreams of going to space. It's a long-term goal of theirs, but they're also very clever business people. Like, they are some of the world's best business people. You can't deny that. And there's something to be said. You know how far, like, everything we see in the news is just SpaceX. Oh, look, they took, astronauts to the space station. Oh, look, they've launched this satellite, that satellite into space. And then there's kind of these two other companies run by billionaires, Branson and Bezos, and they're kind of like, you haven't really done much, have you? I mean, one of your rockets blew up, Branson, and then Bezos, you guys haven't even reached orbit yet. So you kind of get this over time in the media, because they shouldn't be, but they always are compared to each other. You end up getting this effect where it's always just SpaceX crushing all the goals, and you get these other two which kind of just aren't going anywhere. So I actually think this in itself, this launch by Branson was such a good marketing ploy, just an incredible marketing ploy to completely rewrite the media's perception of his company. Because, I mean, they've, unfortunately, I think it was in 2014, their prototype blew up and it killed one of the pilots. So it's, this project has not been without loss and without setbacks, and the media loves to get on negative news. So I think this is just such a smart advertising marketing strategy from Branson. Get up there, get all the eyeballs on Virgin Galactic, get the general public talking, not just the space industry, get the general public talking about it and how the mission was a success, how everybody could tune in. I mean, the live stream has 7.8 million views. So,
it's done well.
I think it's very smart. And it's at a time where, you were seeing the media get on top, like they were reporting how Chamath Palihapitiya, the chairman, completely sold out of his position in Virgin Galactic. We saw ARK Invest, we spoke about on the podcast. ARK Invest completely divested from Virgin Galactic. So it's like just little things over time start to stack up against Virgin Galactic. But I think this is a complete reset, very smart marketing. Now everyone's on board. And it just quickly, when this happened, I logged on to every single news site I could think of, and every single news site had this story plastered on the front page. I mean, how smart is that? Every news site except Fox News, funnily enough. But how smart is that marketing? I mean, it has worked a treat.
Yeah. Unbelievable. What does this company actually do? Do they actually do anything beyond their plans to do what you described, which is have this like tourist? So it's just purely a tourist space.
I think it's just space tourism.
Right. Okay.
They've just put all of their energy into designing this rocket system that can get passengers to space.
Okay.
They're not trying to, I don't think they're trying to reach orbit or anything, which is obviously important for like space operational activities. I think it's just space tourism.
Yeah. So that's actually quite different to something like SpaceX, right?
It's completely different.
Actually, in some ways you would imagine, you could describe as being a little bit more practical in what, how the way they're generating revenue and services that they're providing so. Yeah, it's kind of interesting. I don't know too much about these businesses except that I mean, a lot of people like to speculate on their stocks. Yeah. That's pretty much all I know about that. But very interesting. Yeah. When's Bezos's flight? Must be I think it's in a week or so.
I think that is in a week. I think that's on the 20th or the 22nd, maybe.
Yeah,
it's coming up.
Let's have
it's coming up real soon.
Google search 20th of July.
Oh, so we'll be able to talk about it on next week's podcast.
We will.
That'll be a good follow up.
Yeah, hopefully it goes well. Fingers crossed. Nothing. No issues.
Uh-oh. Although, I mean, if something went wrong, I mean, he has stepped down as the CEO of Amazon. Jeez, that would be horrific. Imagine, oh, man. That's the opposite of good press.
No, as much as it's fun to joke about things like that petition we spoke about, I think last week or the week before, where people are saying hopefully he doesn't come back and stuff like that. But you always these things kind of always make me so nervous. Even when Red Bull does stunts, we spoke about Red Bull stunts, I think a couple of weeks ago as well. It always just makes me so nervous. I just don't want to watch something go wrong. It's
so true.
The last thing I just want to see is like someone jumping out of space and then the parachute doesn't pull or something. So
yeah.
Anyway, sorry to end that story.
I'm like that as well. I hate watching things that could potentially go wrong.
Yeah,
I'm absolutely with even like like I hate listening to people sing the national anthem on live TV. Like, because I hate the cringe when they get the words wrong, or listening to the last post on live TV and then they just stuff it up. Oh, even like live interviews sometimes I'm like, oh man, I can't watch this because I feel so awkward when the interview becomes really awkward.
Yeah, it's the worst. It's the worst. So fingers crossed, all things go well, and we'll talk about it next week. Speaking of speculative stocks, AMC has been diving over the past month or so, and I saw that. Well, all of the stocks related to that whole short squeeze meme stock mania, which has kind of seemingly died down a little bit at the moment, although I kind of thought we had already finished it before AMC shot through the roof. So these things kind of seem to go up and down, but at the moment, there was an article out of CNBC that kind of just drew on what is happening with some of these businesses now. So AMC is now 50% below its all-time high, so down quite significantly from where it was a little bit over a month ago, a couple of months ago. GameStop is also down 50% from its all-time high, also down 40% this month alone. So particularly in the last few weeks, these businesses have started to be fallen out of favor with retail investors. Blackberry was another one which wasn't spoken about in the article, but I was curious about because Blackberry was one that a lot of people thought was going to really catch on as the next GameStop or the next AMC as being one that would get short squeezed. It didn't quite squeeze as much as the other ones. That one is down 57% from its all-time high. I mean, the reason why we know about these businesses, I mean, they're relatively small companies, not doing very well, but we know about them because, of course, they became potential short squeezes by the Wall Street Bets Reddit community, which finds stocks every now and then and decide that that they want to go in together and invest in these businesses. I haven't invest very loose use of the term there, but I haven't had a look at Wall Street Bets recently. I wonder what's going on over there. Like what?
I wonder what's cracking.
I wonder what they're looking at. I look over there every now and then. Most of the time, it's just memes and people kind of joking around. So maybe there's nothing too exciting going on over there. But a lot of people just kind of showing screenshots of them being down and saying they're holding the line.
Yeah, it's basically just like a misery loves company kind of scenario, isn't it?
Yeah, it is a little bit like that.
Yeah, you just post your massive bets that you hope are going to make you rich but never work out, and you're down like 80%. Then you post it on Wall Street Bets, and everyone says, "Oh, mate, it's all right. I'm the same. I'm down 80% alongside you." Misery loves company. That's pretty much all it is. I wonder if what is it? Deep effing value is still got his options contracts rolling
for GameStop. Was that, I think?
Yeah, he was the guy posting on GameStop how he turned. He did like daily updates of how he turned, I don't know, something like 50 grand into $4 or $8 million or something like that. But I remember that's really what got this whole thing going, was watching his success, and he posted about it every day and people were tagging on to that. Oh, maybe I can do the same. That's really what triggered that big spiral. And then all the stuff about, we can short squeeze this, let's keep going. And then it just blew up to something enormous.
Yeah, really a bet of a lifetime, that one. 50,000 into
I reckon
a few millions. Not something you usually do multiple times in your life, if ever. So I'm sure he was very happy about that. But I kind of just wanted to see what was happening, because AMC in particular, AMC was one of those sort of meme stock businesses that were really proactive after the stock exploded and took advantage of the huge increase in the stock price. AMC stock is still up 1,400% over the past year.
Crazy.
And management really took advantage of that by issuing a lot of shares and raising a lot of capital, selling new shares to the public at those higher prices, being able to get a bunch of money in capital and using it to kind of save their business for a little bit longer, which was dying really at the hands of the the pandemic. But I had a look this week. AMC is, there's a bit of so prior to this week, AMC had submitted a filing to the SEC where they were going to ask shareholders to allow them to issue another 25 million more shares. So I think they currently have, I think they have about half, I think they have 500 million shares. So it wouldn't be a huge raising compared to some of the ones they've done previously, but they wanted to raise more shares. Most recently in June, they sold 11 million shares. So they've kind of been frequently during 2021 raising more shares. In June, they were able to raise a total of $500 million. So not a small raise at all. Yeah.
I was just going to say, so they want to raise more money, but I'm thinking like this AMC is the theater chain.
Correct.
So if they're going to raise all this money, I mean, for me personally, if I'm invested in a company, say I'm invested in Tesla, right? Which I am. Don't just say I'm invested. I am invested in Tesla. But, if they raise money, then, yes, I'll get diluted. But I'm also like, okay, if you can explain to me why you're raising this money, where that money's going, so that I can make a decision as to whether I think it's smart, whether I think it's going to lead to you guys being more profitable in the future, then I'm like, okay, that makes sense. But I'm thinking like AMC's a theater chain. Like, if they raise money, what are they going to do? They're going to open more theaters which are already struggling, or are they trying to change it? Did they give any color or any flavor as to what they're actually going to do with this money?
Well, so they haven't actually said what they're going to do with it, but there's a couple of things that, they kind of have in a way. So the most obvious way that they would spend the money is to pay down some of the debt that they have. So currently they have $4.5 billion in net debt and deferred rent, so rent that they haven't paid yet. So it's a significant liability that is coming due, and they'll need to pay that. They also had indicated that they were eyeing off a couple of acquisitions of other companies, which is kind of exactly what you just described, that they would be buying more dying theaters. I mean, that's kind of their expansion plan, I guess, to capture more revenue. And I mean, that's really all that businesses like this can do, because they're not going to, it's very unlikely they're going to do anything within their theaters that's going to reverse the trend that's been going on for 20 plus years, which is less people going out to theaters and more people spending money on their own home entertainment setup, buying a bigger TV, buying better speakers, and just watching movies online through streaming platforms. That trend has been going on for a really long time, and I don't know if they could do anything to kind of stop that. Maybe they can slow it down or something. But the only thing they can do is to grow is to just buy other businesses and capture more market share, essentially, even though the market itself is shrinking. So that's a couple of things they could do. But I mean, even if they sold an additional 25 million in shares, at the current price, let's assume a best case, then that could raise about another $800 million. They would still be in the multiple billions of dollars of debt, and they're not a profitable business on a consistent basis. So, it still raises significant doubts about their ability to survive over the long term, frankly. But the story that happened this week actually was that the proposal was actually withdrawn from the SEC. So it doesn't look like that specific $25 million share raising is going to go ahead, but considering the stock continued to fall massively over the past month, I think investors know that there's more raisings that are coming. It's very likely that they're going to need to raise more, and I don't know. Investing in AMC to me is kind of like if you bought a pizza. Let's imagine there was like a pizza, right? And you bought a piece of it for $5, but they hadn't cut the pizza yet. Right. So you want to invest in this company. Let's say you're going to hold it over the next 5 or 10 years. They haven't cut the pieces yet. And when you bought that piece, you were promised a quarter of that pizza. It was going to get cut into 4 slices, but now it's getting cut into 8 slices. And you're hearing of another raise. It's going to be cut into 10 slices. So now you're at 1/10 of this pizza. And at the same time, you're looking over at the table and the pizza's actually shrinking as well over time. They're actually,
that's a good analogy.
They're actually losing revenue.
And your piece still costs $5.
And you can't sell your piece for $5 anymore. So that's kind of what it's like investing.
That's a great analogy. I love that.
In AMC, you don't really have any idea what you're going to end up with if you hold it over the long term, and I think that's why the stock's falling. So that's my perspective on that.
Look,
but yeah,
no, I agree. And to be honest, I think this is just going to keep fizzing out. I mean, you can't stand up as an investor and say, oh, look, I think AMC's going to come back. I think GameStop's going to surge again. You can't say that. I mean, the only thing you can logically say is, yeah, this is going to fizz out at some point.
Yeah.
It's just, yeah. I mean, yeah, it just doesn't look likely that this thing's going to continue for very long.
Yeah, there's a point at which you can no longer rely on people speculating. And I mean, at the end of the day, the business has to survive. It has to be viable.
Absolutely.
And if they can't pay their debts, it really doesn't, the speculation game is over at that point. And it will be well over before it gets anywhere near that, because as soon as there's a hint that they're in real trouble. Well, I mean, they're in real trouble now, but
but like dire straits.
Yeah, as soon as it looks like they're really not able to pay those debts, then they'll be in big trouble. But maybe it won't come to that. Maybe they'll be able to raise capital. Maybe they'll be able to turn their business around. Who am I to be so negative on AMC's business?
You would not be well received on Wall Street Bets, Hamish Hodder. Maybe you should don't start posting there.
Have you heard of this Hamish Hodder guy?
Gosh, what an idiot. Oh dear. Hey, shall we move on? We got to talk about this Trump story.
Oh yeah. Okay.
Yeah. We'll make this quick. I know, guys, I don't like talking about the guy either. But this one's kind of funny. We can kind of have a bit of a laugh. This is the only story we didn't get to last week, so I thought I'd chuck it in here. So this is news from like just over a week ago, I think, a week and a half ago. Anyway, it says here, Trump sues Facebook, Twitter, and Google. Oh my gosh. Good luck, Trump.
Oh, no.
Yeah. The article reads, former President Donald Trump took his fight with the three massive tech companies to court, filing lawsuits that legal experts say are all but guaranteed to fail, even as they rally Republican voters, fundraisers, and donors. Trump revealed last Wednesday that he is suing Facebook, Twitter, and Google, as well as their respective CEOs, Zuckerberg, Dorsey, and Pichai, in class action lawsuits. The lawsuits were unveiled just over a month after Facebook decided to uphold Trump's ban from using their platform until at least January 2023. Twitter, Trump's preferred social media outlet throughout his one term in office, permanently banned him on the heels of the January 6th invasion of the Capitol by a mob of his supporters. Quote, "We're not looking to settle," Trump told reporters at Bedminster when asked about the lawsuits. Quote, "We don't know what's going to happen, but we're not looking to settle," he said. So the three lawsuits filed in federal court in Florida allege the tech giants have violated plaintiffs' First Amendment rights.
It's okay, Trump.
All
Facebook,
right.
Twitter, and Google and don't want to settle either. They just want to beat you, so...
Yeah, they want to flex their muscles. Former president of the United States. No worries, we got you covered, mate. Not so powerful now, are you? But anyway, yeah, this is a classic. I mean, classic Trump in the news again. Also from this article, quote, "I think the lawsuit has almost no chance of success," end quote, Vanderbilt University law professor Brian Fitzpatrick told CNBC in a phone interview. "The tech platforms are private entities, not government institutions, and therefore the plaintiff's claims about constitutional violations do not hold up," Fitzpatrick said. Quote, "I think this is just a public relations lawsuit. And I'll be honest with you, I wouldn't be surprised if it ends up with sanctions against the lawyers for filing a frivolous lawsuit." How funny is that?
That's great. I love how everybody is just like, what? No.
Yeah.
You can't do that.
Are you serious? One thing that was interesting, I didn't realize that you can get, a fine, or you can get some sort of repercussions if you file a lawsuit that is kind of a waste of time. I didn't realize that was a thing.
Oh yeah. Yeah, of course.
It makes sense, but
Need to have.
I'm just surprised. I just didn't know that was the case.
Yeah, fair enough. No, I just like that. I don't know. I mean, Facebook just fended off the federal and 48 states.
Yeah, that's right. That's what we're talking about.
That court case didn't even get started. The judge Facebook was so good at defending that they just threw it out before it even got started. They couldn't even prove that it was plausible that the US federal government couldn't even prove that it was plausible that Facebook was a monopoly, and Trump thinks that his lawsuit will have any better shot against all three of them with three companies worth of resources. I just find that kind of funny.
It's pretty funny. They banned me because of their rules, and I'm not happy about it, and I think that's unconstitutional. Good luck, Trump. Good luck. No, not good luck. I do not hope this goes through. Anyway, interesting. Very interesting. All right, that's all. That's really all I had to say about that news story. Shall we move on into something else?
Yeah. Do you want to go through this Robinhood story? Robinhood. When's their when's their IPO supposed to be? Is it? Do we have a?
I don't think they've put a date on it yet.
We haven't got a date for it yet. Yeah.
No, not yet. Hopefully we'll get that soon. I actually read through their S1 file after we spoke about it a little bit last week on the podcast.
Oh, yeah.
I read through and looked at some of the, went deep into some of the payment for order flow stuff, which is actually pretty interesting. But anyway, different topic. This topic we're talking about today is a news story that just came out saying Robinhood reserves 20 to 35% of its IPO shares for its own customers, which I thought is interesting. I mean, could work out in their favor. I mean, they are a brokerage platform, so it's kind of a interesting loop that they're in. They're IPOing, but they can offer the anyway. So it says here, if you invest through Robinhood, you may get early access to shares when the company goes public. The online brokerage is reserving 20 to 35% of shares to be sold in an initial public offering for its customers, according to its most recent regulatory filing. Typically, smaller investors must wait until shares start trading on an exchange, and at that point, they may be paying more than those who got in early. The average first-day return for IPOs last year was, get this, Hamish Hodder, get this, the average first-day return for IPOs last year was 41.6%.
Oh, God. Yeah, we're in a bubble. Run.
Yeah, that is insane, isn't it? 41.6% on average in a day. No wonder everybody was talking about IPOs. Anyway, that's according to data from IPO expert Jay Ritter, a finance professor at the University of Florida. It says here, Robinhood's early shares for customers would be available through the app's own IPO platform. SoFi Technologies is another financial technology company that now allows individual investors to get in on new offerings. Still some things to consider, according to IPO expert Jay Ritter, a finance professor at the University of Florida, as I just said. He says, for starters, even if you're able to request shares early, it doesn't mean you'll receive the amount of shares that you actually want. Generally, the more demand there is for any given IPO, the harder it is to get your hands on shares. So it says, if many of Robinhood's 18 million clients want to buy shares, they will only receive a few shares per account. He also notes the importance of reading the company's S1 filing and not going in blindly thinking that all IPOs will go up. That's actually legit. That's like some of the pointers they had in this CNBC article. It was like, this professor of University of finance professor, University of Florida, says, make sure you read the S1 filing. Like, if you're a Robinhood user, at least read the S1 filing and don't think all IPOs go up.
You just know nobody reads that. Maybe like 5%, 10% of people who invest in these IPOs or in any business at all goes through and actually reads a full annual report or an S1 filing. So
yeah. So true.
It's pretty funny. No, but it is interesting that, I mean, of course, because there's a limited number of shares that they're selling at a fixed price, it's not yet in the open market when you're going into an IPO. So you can't, there isn't always shares available to you. The price doesn't just adjust based on, supply and demand. There's a fixed number of shares that they're selling, and they're selling it at a fixed price. So there can be a shortage if there's a lot of interest. So it is interesting to see that they're doing this and giving retail investors access to this IPO, which is it's sometimes retail investors don't have access to these kinds of offerings. So very interesting.
I think it'll be interesting. I wanted to get your take on this because I kind of see it as smart business for Robinhood. They know that they're a brokerage platform. They can offer, they can do this. That's like what their business is about, brokerage. We can offer IPO shares. We can actually do this. So, if we can then offer our own IPO shares to our users, I mean, surely that can only help boost buying, right? You get more retail speculators on board. I mean, it's got that kind of sales smell to it because it's kind of like, oh, limited time. You've got to get in before the IPO, which is this date. Otherwise, this is a special offer. It's got all those kind of those smells of like the sales tactics, like oh, limited offer. We're offering you something that other people can't access, but only for a limited time. Might make money in the process. So, what do you think? You think this is smart by Robinhood? I think it's
definitely
smart strategy. I wanted to get your take.
Yeah, I definitely think it is. And imagine if there's a lot of people, a lot of retail investors who want to access the IPO and come out of it with, far less shares than they requested or even no shares. It could lead to a lot of retail investors believing or seeing that there's a lot of demand to invest in Robinhood pre-IPO, and therefore more people may be likely to invest after the IPO. And of course, for a business like Robinhood, a new business that I don't believe they're profitable, right? Or maybe if they are, they're very limited.
Oh, it's like break even, yeah.
Very limited profitability. They are a company that, of course, they're going public as well. They just want access to as much capital as possible so that they can grow as quickly as possible.
Absolutely.
And how do they do that? Well, they want to attract as many investors as possible, even if they're speculators, so that the stock price can go as high as possible and that they can sell more shares in the future. Because, new businesses, I don't know what Robinhood's plans are after IPO, but it's very likely, like most new unprofitable businesses, they will continue to sell more shares, especially if the stock is really, really expensive. So, when a business needs capital to function, when it's not kind of a business model that works on its own yet, or to a big extent yet, or they have big growth plans, they want as many people as possible to speculate on the stock so that they can raise more capital. Very, very smart move, I think, and we'll have to wait and see. Haven't said that before.
Hey, I've got this interesting side note that came up from this article. They actually showed these statistics. This data in the article says the article shows so far this year there have been 215 new listings.
Oh my God.
So that's just in 2021. And that's nearly as many as the 218 IPOs in 2020. So we've almost got the same number of listings this year versus the whole of 2020.
Yeah, that's not good. That's
how crazy is that?
That's quite concerning. Yeah. I mean, we just came out. We're still in a pandemic.
I know.
I am just perplexed every single day that I wake up and I just see that the stock market is higher, that stocks are higher, that things, it's just, I don't know. I'm just amazed.
The truth, Hamish Hodder, is stranger than fiction.
I thought we would still be struggling economically. 12 months after we started something that's like a one in a century event. It is kind of crazy. I was looking at inflation numbers yesterday. I was just curious, and I was putting together a video as well. Inflation this year so far in the US has been 3.7%, and at the start of the year, the expectation for the entire year was 2%. So
wow,
that's kind of another thing where, all of this is kind of just showing how hot the economy is running right now. And when the economy is running hot, people want to list their businesses and get access to all of the huge amount of money that's flowing around the markets.
Exactly. Yeah, exactly. Says this will be the busiest year for IPOs since 2014, where there was 274. But you can imagine on current pace, it's going to crush that.
Oh yeah.
But yeah, what you're saying is exactly right. This is when everyone's cashed up. And this is a sign. This is actually one of like the unofficial signs that you're in a bubble, is when there's just a heap of new listings.
Yeah.
And it's because it's not a scientific fact or anything, but the logic behind it makes sense, as you were describing. All these people that want to take their private companies public, they want to do it at the best possible time where they can get the most bang for their buck. Everyone's paying a high price for everything, so you can sell less shares for a higher price, or sell the same amount of shares for a higher price and raise more money in the process. So you keep an eye on this IPO data, and it just generally tends to line up when the IPOs are extremely common. That's seemingly when the stock market is in that bubble territory, because it makes sense to take your private company public when we're in bubble territory, because you can just raise so much money.
Yeah, exactly right.
And that's what we're seeing with capital raises at the moment as well.
Definitely.
Everybody's trying to raise. Some companies are raising capital because they have to, because they're in strife. But a lot of companies are just raising capital because their stock is just at all-time highs, and they can just raise a lot of cash.
Yeah, money is extremely cheap right now, both when raising shares and debt. Debt is extremely cheap. It's very, very low interest rates at the moment. But raising equity is also very cheap because everything is so expensive and prices are so high. Businesses can sell a small amount of their ownership, a small percentage of, say, a founder owns 100%. They could sell 10% of their business at a really high price. And that means they're able to get a lot of money really cheap in terms of equity. So yeah, it's an interesting time. We'll continue to watch and see what happens. I would just be, I don't know. I'm a lot of the time I'm surprised with what happens in markets, right? I didn't expect last year to happen. I didn't expect it to end so quickly for the stock market, at least, and to be whatever the stock market is 30% higher than pre-pandemic levels or something ridiculous like that.
Yeah.
So you can never know what's going to happen. You can only just watch it and kind of get the popcorn out and enjoy the ride. Exactly. Is the way to go about it.
You describe it as interesting. I'm calling it flat out bonkers.
Terrifying is another word.
Sorry, terrifying. Yeah, there's a lot of descriptors you can put on that. Anyway, let's. Should we move on? That's all we've got to talk about.
Yeah, I think the last story. Yeah, I think the last.
Tell us about our beautiful U.S. Democrats' $3.5 trillion bill, and if you can make it as boring as possible, that would that'd be appreciated. We're just having way too much fun at the moment.
Okay, right.
I think we really need to just bring it back. Yeah.
The US Democrats this week released the framework for a $3.5 trillion bill.
Yeah, say it like a bored news reporter.
I can't even do that.
As expected, the Democrats are continuing to push for more spending in lots of areas. Imagine if we just came out and did a full podcast like that. Do you reckon our viewership would just fall off a cliff? I think it probably would.
I'm pretty sure some people would click off that. I don't think.
Anyway, sorry. No, let's all right, tell me about this bill.
Yeah, the headline caught me, and whenever I see, a huge number like $3.5 trillion, I always think two things. Wow, that's a lot. And then, is that really a lot? Like, I don't actually know what's a lot for a budget, but this week we got to see the Democrats' their framework for their bill. They haven't put together the bill yet, but the framework for how they're planning to spend money in 2021, their entire, or it must be, I don't know when this budget is actually for, whether it's maybe it's for over the 12 months from when they push it through. But the reason why it's in the news particularly is because it's the second largest deficit that will be created if it does go through, only second to 2020, which kind of makes sense because 2020 was pandemic year. It made sense that they had to do a significant amount of spending, but this year is close behind it, the second largest deficit since 1945. Interestingly enough, in the article, Bernie Sanders proposed a $6 trillion bill, but the centrist Democrats didn't really go for that one. But I just thought that was funny that they put that in. Bernie Sanders with his twice as high bill, that would have been a record bill. But yeah, they basically gave a summary of some of the things they're planning on spending money on. Some of the things from the list here: free universal preschool for 3 and 4 year olds, free community college for all students. What else have they got here? They extended the $1.9 trillion COVID stimulus plan for lowering health insurance premiums for those who can't buy coverage on their own. And they extended the child tax credit expansion that was included in the COVID relief bill. So some of this is kind of just taking what was in the COVID bill from earlier in the year and just extending it on, basically saying, yeah, we did these things, during as COVID relief, but we think they're good initiatives that we should continue to spend money in that way. I mean, what does this mean for investors? I won't spend too much time going through this because I know it's really dry, but really, I think the key thing to think about when it comes to what this means for investors is it's not necessarily good or bad for governments to spend more money, but when they do spend more money, the concern that we should think about is whether it's going to create inflation, right? The current US debt is $28 trillion. So that would go well above $30 trillion if this was to go through. Interestingly enough, I actually didn't know this, but $22 trillion of that debt is held by the public. So the vast majority of that debt's held by the public. And, why is that a concern? Why is someone like Ray Dalio concerned about how much debt that's held by the public? Well, if the public starts selling those bonds, which could happen because as inflation rises, the returns on those bonds, gets worse and worse. It can even go negative. If the public starts selling those bonds, then the Federal Reserve has to kind of step in and print a bunch of money to fill that demand gap. At the moment, the Federal Reserve is spending $80 billion a month on printing money and buying government bonds to fill the demand gap because the government is spending so much money and needing to take on more and more debt to do so. But if, a significant portion of that 22 trillion that's held by the public starts to be sold off as well, then the Federal Reserve needs to spend even more money, print even more money to stop interest rates rising. And that's where inflation can kind of get out of hand. So that's what Ray Dalio has been talking about. He recently released an interview that he did on Bridgewater Associates YouTube channel. So you can check out that interview if you're interested, or you can check out my YouTube video where I went through it.
I saw that one.
That's what Ray Dalio is really concerned about right now, is this idea of monetary inflation, and whether we'll see that in a big way. But yeah, I don't know. Do you have anything to kind of say on that? I don't really. Yeah, it's kind of dry. It's something that's. Yeah. I don't know. There's not too much to say about it.
Yeah, I don't think I could add anything that would be particularly of value. Macroeconomics is definitely not my jam. It's good. It's good to follow, and yeah, I think just on a broad level, I think Ray's right, and something we've been following as well on our channels is watching what inflation's doing, because you're right. Going back to what Warren Buffett said in his in Berkshire's annual shareholder meeting, when talking about economics, he's saying you can't just do one thing. In economics, you have to do something and then ask, okay, now what? Like, what's going to happen? It's like scales, you put something on one side and then it changes the other side. And economics is always like that. You can't just get away with doing one thing. It's not just like, we'll just print $2 trillion and then that's that. There's always a consequence with economics. So I think it's just important. You never really base your investment decisions off this sort of stuff, but it's just important to kind of vaguely keep track of and understand what the concerns are. Like, we're concerned about inflation with all this money printing, and just keep a track of what's going on there. Just keep yourself, I guess, well educated, just in the know, so that nothing catches you by surprise, I guess. But yeah, I don't really have anything to add specifically to this story in particular.
All right, should we jump into some Q&A then? Because we've got a few. We've still got a bit of a backlog. Okay. But as always, if you guys do have further questions or even news topics that you want us to cover, or as we're coming up on earnings season, if you have companies that are reporting earnings that you want us to maybe take a look at, make sure you head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest episode and leave your questions or topics as a comment below the latest episode. All right, where should I go? Maybe I'll read this one to you. Can I read this one to you?
Yeah, sure.
Yeah, so, okay, this question is, there's a family-controlled company I really like. However, during my research, I saw there was a massive lawsuit among family members. The CEO and chairman are children of the founders, and they were sued by their own children. Is this something to be wary of? The stock is ROL, if that helps.
Right. So the CEO and chairman are children of the founders, and they were sued by their own children. Oh, okay. So it's like, yeah, it's this whole family feud thing. Well, I mean, you know, it's something to be wary of for sure. It's something to, it's not necessarily a deal breaker, I would say, but it's just you wanna understand what's going on. That's really the key. Like the key to everything, I would say there are a few things that are deal breakers, but even things that seem like deal breakers can often not be that bad as long as you understand why that situation is occurring. For example, I don't know. It's like a company takes on a bunch of debt or something. I mean, if your debts get too high, that's not good. You'd say, oh, that's a deal breaker. But if they clearly explain exactly where that money's going and they're printing money at their stores at the moment, and if they open 10 new stores, then they're going to print 10 times the amount of money, then it's just like, okay, well, maybe that's a good argument. So there's always these things, and that's what we always say. We have these kind of rules of investing, I guess, but when we look at a company, there's always things that don't go to plan. You never get that company that just ticks every single box. So I think it's just a matter of, it's not so much a deal breaker. It's more just something that you need to understand. I'm not even sure what this company is, so I'm not sure of the context of this, this lawsuit. But it definitely throws a spanner in the works if it's a family-controlled company and they're, the manager. I guess they're the management, and the management are now feuding, and lawsuit among family members. I mean, you just got to figure out what's going on.
Yeah.
And whether it will materially impact the company, whether it will impact the management's ability to grow the company, whether it will impact who the managers of the company actually are, all that sort of stuff.
Yeah.
Maybe it's just like a silly little thing, like the children are running the company better than ever before, and I don't know, they're suing their father because he's a corrupt prick or something like that.
Yeah, it definitely depends on the context of the specific story. And I think ultimately you need to make a judgment. This all comes into assessing management's integrity, whether you trust the management team. So ultimately you just kind of need to make somewhat of a subjective but rational decision about whether you trust the management team. And I can give you an example of something similar to this, but not really. So I was looking at a company called National Beverage Corporation, and they own, what's the company? LaCroix. They own LaCroix, which is a very popular sparkling water brand, or flavored sparkling water brand now. And the company had performed extremely well recently. But when I looked into the CEO, and it's a family-run company as well, I found nothing kind of, no like lawsuits or anything, but there was a lot of comments that former employees had said about the potential that there's being fraud committed within the company. And look, fraud is one of those things where I know that I'm not going to be able to look at a balance sheet or look at annual reports and know whether someone is manipulating the numbers. That's just something I'm not going to be able to do. So the fact that there had been a couple of accounts of that, I have no idea if it's true. Maybe it's not. Maybe I'm missing out on a good investment because of it. Because it created a level of uncertainty that I wasn't comfortable with, and that I felt as though I couldn't identify whether fraud was happening or not, I decided to leave that company and not look at it anymore. So
Yeah.
That's kind of me making a judgment, just thinking, there's a level of uncertainty here that if there is fraud happening, the investment's probably going to go to zero. So that's a big that's a big thing to consider. And I felt as though there was too much uncertainty there. So I think you just got to take it on a case by case basis and kind of understand the circumstances. And if you're not sure, then just leave it. There's plenty of other businesses that you can look at.
Yeah, absolutely. Yep, I definitely agree with that. All right, let's move on. This one here.
Okay.
What method do you guys use to determine the discount rate you should use for a company's intrinsic value calculation?
That's a really good question, because there's a lot of different opinions on this. So I can give you my opinion, and I'll also give you what traditional finance institutions will do and what you would learn if you went to university, for example. So what I do personally is I set the discount rate at the target return that I personally want to make. And that makes sense because the cash flow that I'm putting into the discounted cash flow, so the cash flows that I'm actually discounting, are reflective of how much cash is being returned to us as shareholders. So that's Warren Buffett's owner's earnings figure, or I call it cash flow for owners. If you study finance at university, they will not do that. They will use something called the weighted average cost of capital. And this is basically an average or a ratio of the cost of the debt for the company and the cost of equity. Now, the cost of the debt, that makes sense because there is a cost associated with debt. It's the interest rate that's associated with the debt, right? And that makes perfect sense that you would want to discount at that rate to determine, particularly it makes sense if for businesses doing internal investments, because they want to make sure that the investment that they're making, the project they're undertaking, is going to deliver more than the cost of debt, for example. But under the cost of equity, you then start to get into using things such as the CAPM model, which basically, in a nutshell, not really, but in a nutshell, it's coming up with a guess for what return the market wants to achieve on that particular stock. And to me, that doesn't make any sense. To me, it makes no sense to assess the cost of equity as some market figure based on the price movements of the stock when we are the equity, when you're the person investing in the business, you're the person putting money into the business. So in my view, it makes more sense to focus on the return you personally want to make from the business. So that's kind of the two ways that I think a lot of people go about it. How do you? What's kind of your process for this, Brandon?
Yeah, I just grow the cash flows, discount them to what they're worth today, based on 15%, based on me wanting to return 15% per year. That's literally it. I mean, it's pretty straightforward. The way I see it is that, if I discounted by any less than 15%, then I may as well just buy, an ETF and be done with it. Discount by 15%. And if I get that each year, I'll be happy and compounding my money well. So that's pretty much it.
Yeah. I mean, the weighted average cost of capital works really well for internal investments that businesses make. Because you're talking about a fixed project. Maybe they're building a new restaurant or something, and they're running calculations on this, and they have to use, they're funding it with 40% debt and 60% from a group of private shareholders who have said that they're aiming to make this certain return. Or maybe there's a particular return that has been not promised, but has been kind of used as a benchmark to get those investors on board. In that case, it makes sense because you can run the calculation. Okay, using 40% debt, 60% equity, we need to get a 12% return for the shareholders. We need to cover a 4% cost of debt because that's the cost of the loan, blah, 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 blah. You can calculate whether a project is worth doing or not. But when you're talking about a stock market investment, it doesn't really make any sense to do it that way. It makes much more sense to assess it as if the cash flows are coming only to you, as if you're buying the whole business. That's the way Warren Buffett talks about it. And what return would you want to make? And that's the rate at which you should be discounting those cash flows. So, yeah.
Yep. That I agree. All right, shall we wrap things up?
Yeah, let's wrap it up there for today. Thanks, everybody, for tuning in, as always. And as I just mentioned, if you have more questions or topics, head over to the YouTube version of the podcast and leave them there. We've still got a couple to get through, but we are getting through them, so we still need more questions to come in every single week. So if you do have them, we appreciate you leaving them. And also if you have topics as well. Thanks, Brandon, for joining me as always.
All good. Good fun.
Yeah, and thanks Sharesight for sponsoring this week. Head over to sharesight.com/young investors and get 4 months off a yearly subscription if you're interested. But with all of that said, we'll see you guys next week. See you later, guys.
Bye-bye.